Okay. Hi, I'm Peter Rose, founder of Longwood Currency Trading. I want to talk to you today about the importance of the win-to-loss ratio in determining the success or lack of thereof of your trading results. I came out here, it's a beautiful mid-August 2023 day. So I came out, we've had a lot of rain the last few days, quite a bit. But I came out to check out the brook. Let me see if you can see the brook. I had expected a lot more water to be coming down the brook. We don't really have any coming down right now. We had a period the other day of about 2 inches an hour, and it rained for about an hour. So up on this mountain, about a third of a mile down the side of from the ridge of this mountain, and so we tend to get quite a bit of rain throughout the area, and so I thought we would get a little bit more there, but that's the way it goes. Statistically speaking, that brook really rolls over when we get a couple inches of rain that's come down. It's really roaring. Speaking of statistics, one of the more important, and I don't even know if I'm holding this the right way here, I'm trying to walk up the hill. One of the important trading metrics that I talk about quite a bit is the win-to-loss ratio. You know, the amount of money that you make is the total amount that you win minus the amount that you lose. Big deal. It's far more sophisticated with that, and I don't want to get into a big deal about it. The last video that I did had a discussion of that win-to-loss ratio to a certain degree, so you can see how powerful it is in calculating your results. In the last few videos, I've talked about a computer simulation analysis program that I am writing, and I'm into one of the latter phases of that development, such that I can run 10,000 iterations over a certain group of metrics against a static trading pattern. In other words, I'm building into, it's a complex model. It's building into a position with lots and then staging after the fact, and then you run different win-to-loss scenarios against that, distances between where your staging points are, the number of lots that you're staging. It's a pretty complicated matrix, but just using a simple utilization of the win-to-loss values, it comes out, and these are after running 10,000 iterations against a setting and then running another 10,000 against another setting. So you get a very damped result set from that. It's like the difference in looking at an 8-period moving average as opposed to looking at a 55 or a 200 period moving averages. They tend to smooth the thing out, and you get the true average value over the long term. Now, you could probably get the same results over 100, and yeah, I know I do 100, I do 1,000. It doesn't make any difference. When I run 10,000, I tend to get very, very, very consistent data as opposed to even running it for 1,000 times, regardless of all that. Under certain win-to-loss ratio values, in other words, the percentage of times that you win against the percentage of times that you lose, like 60-40. You win 60 times out of 100 and you lose 40 times out of 100. That gives you certain statistics, as opposed to if you were a 70-30 trader, or an A80-20 trader, or a 30-70 upside down trader, okay? The core thing that I want to point out, and I don't want to give any really specific numbers, because everybody's going to be different, they're going to be trading differently, but under the conditions that I'm currently working with, under certain win-to-loss ratio settings, the average winning position divided by the risk that it took in order to get that win. So if I'm trading in the sample trade that I'm looking at, I'm dealing with 9 lots, and so you can get bumped out after you just put on 3 lots, or you can get bumped out at entry, you get bumped out at the 5 lot position, or the position you work out and you go all the way to the time when you've got all 9 lots on and they have a profit on them. At 1 win-to-loss ratio setting, you get about a 0.42% against your risk. So 0.4%. That's $4 a thousand, right? 4 pips on $1,000, $40 on a full lot. You get about a 0.4% return against your risk. Well, you know, if you're trading a full lot, like I said, you'd have $40. If you're trading 10 full lots, you get a $400 return. And if you balance that 400 against, if you used all 10 lots, that's your 0.4% return. So under those conditions of the win-loss ratio, you get a 0.4% return. In upping that percentage just a little bit, well, I mean, you're going to the next order of interest that I have in those ratios that I think advanced traders are able to achieve. All of a sudden, that average win percent value goes anywhere from between 0.8% to 1.25%. So about a little over 1% return based on you simply getting to be a better trader, let alone how many pips you're getting or any of that, because all that's static. I can't stress enough to you the importance of learning how to trade instead of following these ridiculous indicators and these ridiculous systems that a lot of these folks are talking about in their trading. It's a function of your ability to trade, not what kind of tools that you use to look at the price action. You have to understand what causes the price action in order to make that happen. In the simulation that I'm doing, I'm basing it strictly on the price action. You don't do anything with it. You just follow the I mean, you can't just splatter your lots that you're adding all over the place and say, oh, you know, I'm all set here. You have to understand where to place those lots, so that if you just do a simple paper trade thing, that if you stage in a lot and it goes bad on you, you don't want to let it go all the way. Like if I stage 3 lots and it goes up a little bit and then it comes down, and you take a, say you take a 10 pip loss against that, so you're going to lose, it's 3 lots, it's 10 pips, it's $300, right? You're going to lose $300. But if it goes below the level where you staged the previous lot in, now all of a sudden that one's underwater too, and that could have been a 5 lot or a 10 lot, and so now you're negative, even though you're up in profit from your original point of taking the trade. You could be significantly underwater if you do the wrong thing. So if you just lock down your methodology of increasing your size so that it works out mathematically, and then you see, and it's pretty easy to say, well, if I do this, I'm going to end up with this. Now, it's the number of times that you win as opposed to the number of times that you lose that determines whether those particular settings are going to work for you or not. Obviously, if you're going to lose more, you could have perfect settings, but if you're going to lose, well, if you're a 40-60 trader, you're going to win 40% of the time and you're going to lose 60% of the time. I mean, you know right away what's going to happen with that. If you flip that around and you become 60-40 trader, what does that staging and building process how do those things factor in? That's the thing that I'm kind of talking about here, that the computer simulation works out for me. Now, for example, if I run the simulation against one win-to-loss ratio value, call it 60-40, and I run the simulation 10 times, I'll get a 1% return. Then I run it another 10 times, and I'll get a 0.2% return. And I'll run it another times, and I'll get a negative 3% return. And I'll run it another 10 times, and I'll get a 0.4% return. So just running the simulation 10 times in a row really doesn't do anything. I run it 100 times in a row, and then run it another 100 times. Now the results start to cluster more closely. They'll gyrate between, they're going to end up, let's say, at 0.4% at some win-to-loss ratio setting. So at 100 times, you're going to see a spread between, let's say, 0.6 or 0.7% and a negative 0.2%. Maybe probably a little closer than that at 100 iterations. But when you go up to 1,000 or 10,000 like I did, it goes boom, and it comes up at 0.4%, within 0.1% most of the time. If you don't understand how critical your trading ability is to directly affect the value of your win-to-loss ratio, or you're not working that well enough, man, you're just going to be in deep trouble. And look, looking at a trading metric is not the same as looking at, oh, I've been really successful at a Golden Cross thing or a London Open or some crazy thing, or I've been using my Bollinger Bands and I've been really successful for the last 40 trades. Yeah, but the problem is that a trading metric varies with your trading ability. Your use of trading indicators has nothing to do with your ability. It's blindly following what some setting does. And when the market changes, and it isn't a market that changes yearly or something, the market changes tomorrow. Because the market is order flow based on client transactions being executed by an institutional trader. That's what it is. It's not you influencing the market. As retail traders, we're only, I don't know, it used to be when the currency market was around $4 trillion a day, when I started trading or looking at these markets back in 2007, they were $3.8 trillion a day. Today, in 2023, they're, I think, $6.8 trillion a day, almost $7 trillion a day. When they were $4 trillion a day, the retail market made up 15% of the market, of the order flow. Today, I mean, I don't think in a $7 trillion a day market that 15% of us retail traders are accounting for that volume. I think the volume of the market has far exceeded the retail traders' participation in that market. And so I don't know what that is. You have to look that up. But the fact that there's so many people out there that believe and that are teaching, and thus people believe them, that they have any control over their winning or losing by indicators, by looking at what happened 15 days ago, is crazy. Because that big institutional trader that was unloading $4 billion order, and he didn't do it yesterday, he had to spread it out over 2 weeks. And so you get these movements that are fairly repeatable. You get, they call them channels. The price is bouncing back and forth in channels. That's a huge institutional trader, or several traders that are all trying to get their clients' orders satisfied within those pricing bounds. I don't want to pay more than this, and I don't want to sell it for less than that. So once that is done, that's where you get those breakouts out of those channels, because they're done. They're not trying to push $500 million or $300 million orders through during a trading day. Now, they may be taking 2 weeks to do that. You've seen channels run for long periods of time. Those are huge orders. There's a lot of commerce going on. When times are good, you're going to get a lot of commerce. When times are bad, you're not going to get quite so much commerce, and therefore you're going to get more trending markets. You have to be aware that the indicators that you think are helping you aren't helping you. You need to help you by doing some research on what kind of trader you are. Are you 60-40? Are you 30-70 upside down? What are you? Then you're going to understand what you need to do in order to fix it, because you'll be able to see, I'm an underwater trader. Why am I underwater? I'm taking too many losses, and those losses are far greater than the few winners that I have. Oh, I understand how to flip that. If you don't understand how to flip that, find somebody that's going to be able to help teach you how to do that. But if you just go to them with your give them your transaction log, or you talk to them over the phone and you go over a bunch of trades that you've done, and they're looking at what you're doing, they're just going to say, well, you know, you shouldn't have done that because this level was here and the channel thingy, and it was outside the Bollinger Band, and the RSI was reading blah, 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 and what the fuck were you doing trading then? And the only answer you can have to say is, well, I don't know. I don't know why I didn't take that engulfing candle pattern that you're talking about that I should have taken the trade based on, because I'm looking back in the chart, and there were other engulfing candle patterns, and they were pretty similar to the one that you're saying that I should have taken. Why didn't you take this one up here? Oh, because you did something else and then looked at it and go, oh, because of this engulfing candle pattern occurred here, that's why I took the trade. No, you took the trade and it worked out, and it was because you had an engulfing candle pattern there. Could have been a Golden Cross. It could have been a London Open. It could have been anything. But you can't say, oh, I'm looking at an RSI and I'm going to put my trade on now, because that's a lagging indicator. That thing could have been passed by, what's the RSI lag? What's the ATR lag? What are the boundaries on the Bollinger Bands? How many standard deviations out? Are you at 2? Are you 2.4? Where are your boundaries looking at? And what good does that do? You're tuning the Bollinger Band to meet the existing price action, and then all of a sudden those guys that were pushing those big orders around, they're done, and now you're caught on the wrong side of the Bollinger Band, thinking that it's going to flip and go around. Man, learn how to trade, learn how to develop your trading metrics, and if you don't know which ones are important for you to develop, you got to find somebody that's going to show you that, because you're not going to read it in a book. I've read hundreds and hundreds of books, and I've watched all these videos that you guys are watching, and nobody's talking about this stuff, and I don't know why. But I'm talking about it, and I'm telling you, start looking for what metrics are going to teach you where you're going wrong, so that you can figure out how to fix it. And if you don't know how to do that, well, find somebody that can help you do that. You know, you may spend a lot of money, several $1,000s, learning something. But if that one trick that somebody shows you, or the time that you consult with them or take a course or something, those things that they show you, if they can turn your trading around and improve. I'll give you an example. I was in computer simulation one time, and just by increasing the average win value in pips from a current level to 2 pips more, changed the amount won by thousands and thousands of dollars over a good sample size of trades, you know, like 40 or 50 trades. I use that all the time. But if you don't understand where you find that number and how that correlates with other metrics, you're going to have a hard time improving your trading. by using a Bollinger Band or Fibonacci's. Oh my Jesus. Okay, I'm done ranting. It's a beautiful day. I'm going to go in and get another cup of coffee. If you have any questions about this stuff, please send me an email. Tell me a little bit about yourself so I know whether I'm talking to a 25-year-old or a 55-year-old, because my answers are going to change depending on where you are, what kind of job you have, how old you are, where you live, how much your trading bank is or could be if you figured out what to do. That's stuff that I have to know, not because I'm a nosy SOB, but because I want to help you. I don't want you to have to pay me to take a course or something. If I can help you in an email or something, that's great. Then you're happy, your trading improves, and I have time like this that I can go out and be out on a beautiful day instead of answering emails. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. And I hope that I didn't get disappeared in carrying this camera around. Cut my head off. I'm going to publish it regardless of that, because I got coffee to get, and it's the information in the videos that I do that counts, not the cinematography of it. Thanks.